Ray Dalio, the influential figure behind Bridgewater Associates, a hedge fund giant with assets totaling $160 billion, has provided 3 financial tips specifically aimed at millennials. One of his key recommendations revolves around assessing the balance between freedom and security in one's financial planning. He advises individuals to introspectively ponder questions such as, what level of financial freedom and security do I require? And for how long can I sustain myself solely on my savings without any additional income? Dalio emphasizes the importance of ensuring that one has a financial cushion exceeding the duration they deem necessary for maintaining a sense of freedom and security. Number 1. Decide how much you can stock away. Ray Dalio emphasizes the importance of educating oneself about investing in personalized finance. He advises understanding the workings of money and markets, exploring various investment options, and comprehending the associated risk and rewards. Dalio stresses the significance of savings for both freedom and security, prompting individuals to assess how long they could sustain themselves without income and ensuring they have more than enough saved to cover their needs. Drawing from his personal experience, Dalio suggests gradually building up savings, starting with 6 months' worth and progressively increasing it based on individual circumstances, such as family needs. Furthermore, Dalio warns against accumulating debt for non-productive purposes, stating that such debt is detrimental. He underscores the value of early savings, especially for millennials, but cautions against keeping money solely in cash, advocating for its conversion into investments. Dalio points out that over time, stocks, bonds, and real estate typically yield higher returns than cash, citing historical data on the S&P 500 index as evidence. The concept of compound returns underscores the importance of initiating savings and investing early, as it allows for substantial growth of one's money over time. For instance, beginning to save $100 monthly at age 25 with a 7% average annual return would yield approximately over $250,000 by age 65. However, if one waits until age 35 to save the same amount, the accumulated savings by age 65 would only amount to around $120,000. Naturally, higher saving amounts and greater returns expedite capital growth through compounding. Initiating the conversion of earned income into investment income, particularly into the stock market at the earliest opportunity, is crucial to fully leverage the benefits of compounding returns. Millennials, in particular, stand to gain significantly from commencing savings early due to the advantage of time. Early savers can exploit compounding and consider venturing into riskier investments with the potential for higher returns. Managing high expenses while attempting to save can be challenging. One approach is to establish automatic transfers from a checkings account to a savings account, eliminating the reliance on willpower and allowing for gradual increases in savings over time. Additionally, increasing income, whether through additional work opportunities to negotiate for a raise, can facilitate saving efforts. Prioritizing contributions to retirement accounts is advocated as the optimal method to kickstart this saving process. Number 2. Create a diversified portfolio. Ray Dalio advises investing in assets that have the potential to increase in value over time, emphasizing the importance of diversification beyond cash savings. Historically, assets like stocks and real estate have demonstrated value appreciation and delivered substantial returns to investors. However, investing entails inherent risk, and it's crucial to acknowledge that past performance does not guarantee future outcomes. Therefore, adopting a long-term investment approach rather than attempting to time the market is prudent. A diversified portfolio is essential in investment strategy, encompassing various asset classes such as stocks, bonds, and real estate to mitigate risk and enhance the likelihood of success. According to Tony Robbins' book, Money, Master the Game, Dalio suggests a diversified portfolio allocation comprising of 30% stocks, 40% long-term US bonds, 15% intermediate US bonds, 7.5% gold, and 7.5% other commodities. Dalio recommends annual portfolio rebalancing to maintain the desired allocation. Number 3. Learn the market's long-term cycles. Ray Dalio advises against deviating from a balanced investment mix, cautioning against attempting market timing, which can be challenging even for professionals. Instead, he recommends understanding market cycles and knowing when to buy during periods of widespread selling and when to sell during times of high demand. For millennials with ample time before retirement, there are opportunities to capitalize on market fluctuations. They can increase investments during significant market downturns and reduce contributions towards the end of bullish market cycles. Embracing stock market crashes can be advantageous for millennials, as it enhances their purchasing power. By adopting a long-term perspective of 25 years or more, millennials can recognize the favorable odds for substantial returns over time. alleviating concerns about short-term market fluctuations and allowing for capital growth over decades. While mastering the art of investing may appear daunting initially, it is a crucial step towards achieving financial independence and securing a comfortable retirement through the power of compounding. Fortunately, delving into investments doesn't have to be intimidating. Ray Dalio, a distinguished investor and the brains behind Bridgewater Associates, the world's largest hedge fund, suggests a three-step approach to crafting a savvy business strategy. Despite boasting an estimated net worth of $18 billion by Forbes calculations, Dalio's journey commenced humbly in his two-bedroom apartment in New York back in 1975, when he founded Bridgewater Associates. Over the years, Bridgewater has garnered unparalleled success, achieving the highest cumulative net profit for a hedge fund until 2017, as per data from LCH Investments. Millennials, also known as Generation Y, encounter distinct financial obstacles as they embark on their careers and start to plan for the future. With the burden of student loan debt and an unpredictable job market, navigating through the complexities of saving and investing can be daunting. This is why when Ray Dalio, a highly successful investor and hedge fund manager, recently offered financial advice tailored specifically for millennials, it garnered attention. Ray Dalio, the founder of Bridgewater Associates, stands out as one of the most accomplished investors in the financial world, amassing a net worth exceeding $19.1 billion. Renowned for his innovative investment philosophy, Dalio combines quantitative analysis with fundamental research to achieve consistent and impressive returns for his clients. His approach has propelled Bridgewater Associates to become one of the largest and most prosperous hedge funds globally. Beyond his professional success, Dalio is a staunch advocate for financial literacy and personal growth, evident in his writings such as Principles, Life and Work, where he shares his guiding principles and the changing world order, while nations succeed and fail, an insightful analysis of contemporary political and economic dynamics. Millennials encounter distinct financial obstacles, but by adhering to Ray Dalio's guidance, they can navigate these challenges and secure their financial well-being. Initiating savings early and leveraging compound returns allow millennials to harness the power of time, a vital component in wealth accumulation. Diversifying investments beyond cash savings and opting for assets with growth potential like stocks and real estate are pivotal strategies for long-term wealth building, mitigating risk and enhancing returns. By adhering to Dalio's principles, millennials can lay the groundwork for a prosperous financial future. Commencing early, investing in appreciating assets, and acquiring financial acumen enable them to accumulate wealth, attain financial stability, and overcome their unique financial hurdles, paving the way for sustained financial freedom in the long run. While banking stocks aren't currently considered cheap, December saw a notable dip in their prices, presenting opportune moments for investment. Dalio's increased investment in Bank of America during this period mirrored similar sentiments in the market. The specific preference for JP Morgan raises the question of its appeal to Dalio. Despite its higher valuation compared to Bank of America, JP Morgan boasts several attributes that make it an attractive prospect. Bridgewater's 13F indicates a significant allocation to JP Morgan, surpassing investments in Bank of America. Despite its relatively higher price-to-earnings ratio, JP Morgan's strengths and potential make it a compelling choice for investors. JP Morgan benefits significantly from substantial investments in artificial intelligence, which holds the promise of future efficiency enhancements. Notably, in 2017, JP Morgan leveraged AI to complete a staggering 360,000 hours of finance-related tasks, predominantly filings, within a fraction of the time. The institution has established a dedicated AI research division and holds the top position among banks in Evident AI Maturity Index. AI technology has become a focal point across industries in 2023, with some companies reaping its benefits, while others grapple with perceived drawbacks. Companies rushing to deploy AI products to consumers face potential risks, particularly regarding liability issues stemming from AI-related mishaps. For instance, Tesla's full self-driving feature has been implicated in numerous accidents, while Microsoft's Bing AI rollout encountered challenges such as disseminating inaccurate information and even offending users through its chatbot Sydney. It remains uncertain whether aggressively pushing AI products to consumers is a prudent strategy. However, JP Morgan's approach seems to prioritize leveraging AI for internal automation rather than marketing it as a consumer product. This strategy suggests that JP Morgan could lead in operational efficiency as long as it continues to utilize AI responsibly. That's all about today's video. If you like this video, then don't forget to like and subscribe to our channel. Also, press the bell icon to get notified of our upcoming videos, and let us know your opinions in the comment section below.